We are watching a severe market paradox play out in real time. During the week, institutional inflows drive a slow, steady recovery. Then, the markets close, and we are hit with weekend geopolitical volatility, like the escalating military posturing in the Middle East. When Monday morning arrives, retail investors are slammed with an overwhelming barrage of financial news. You log in and immediately see top-tier brokerages upgrading 10 different stocks, projecting returns ranging from 16 to 59%. Right next to those analyst projections, multi-billion rupee corporate actions hit the tape. Companies like Welspun are suddenly securing infrastructure orders worth over 17,200 crore rupees. This simultaneous barrage of projections and heavy real-world numbers creates an intense fear of missing out. It feels like every ticker on the screen is a train leaving the station, while you stand on the platform empty-handed. Drinking from this information fire hose is dangerous. Blindly trading this news leads to mixing short-term regulatory plays with long-term structural investments. Taking a long-term approach to a short-term policy trade or trying to day trade a 5-year infrastructure cycle will destroy your capital. The timelines clash and the risk profiles break down. To solve this, we use the Catalyst Matrix. This framework forces you to categorize market updates by your specific investor profile, moving past simple buy or sell ratings. Surviving this market requires filtering out the noise that doesn't fit your personal risk tolerance and your specific time horizon. We start with the first major category of market news, structural supercycles. This strategy is strictly for time-poor investors looking to build a long-term portfolio. The input strategy here requires you to accumulate stocks during their active consolidation phases. Think of air conditioning manufacturers like Voltas. The time to build a position is during their seasonal downtime, when the stock is drifting sideways and the broader market is ignoring it. You aren't buying for the next quarter. The long-term thesis is that cooling demand will rise steadily over the next 5 years, fueled by the rapid expansion of data centers that require constant temperature control. You apply that same input strategy to asset management companies, or AMCs, like ICICI Pru and SBI. They are currently riding a multi-year wave of rising retail SIP participation. You buy them when they dip and let the demographic trend do the work. This table breaks down the mechanics. You secure lower entry valuations before macroeconomic demand surges. But look at the trade-off on the right, the patience tax. You will endure long periods where the stock becomes dead money, testing your conviction for months. This dynamic also applies to the second type of structural play, heavy engineering and defense companies like Welspun or HAL, which currently hold deep multi-year order books. Securing a 17,000 crore order provides unparalleled revenue visibility. It guarantees cash flow and balance sheet safety for the next 3 to 5 years. However, buying in after the news hits often means paying priced-in valuations. When you pay a premium on day one, even standard execution delays over a multi-year project will severely drag down your annualized returns. Structural supercycles offer genuine safety, but only if you are willing to sacrifice the excitement of immediate momentum for stable, long-term growth. The second category is regulatory and policy shocks. This high-maintenance strategy is designed exclusively for the active optimizer. Here, the input strategy involves trading sectors that are highly dependent on government intervention. A prime example is Dixon Tech, which rode the momentum of the 62,500 crore mobile manufacturing PLI scheme. Looking at our second table, the upside is obvious. Trading these policy shifts offers the potential for rapid, short-term momentum. You are chasing outsized weekly gains. But the negative side of policy news is brutal. Take the recent sudden removal of the 100% sugar import duty as a prime example of an overnight shock. That single Gazette notification flooded the market with supply and instantly crashed sugar stocks. That brings us to the severe trade-off. Investors here are at the absolute mercy of unexpected government notifications. Surviving this specific quadrant is a full-time job. It requires constant screen time, strict, unemotional stop losses, and the ability to react immediately to news alerts the second they break. A perfect technical chart pattern built over 6 months means nothing when a single policy reversal gaps the stock down at the opening bell. Policy-driven trades offer the highest immediate return on investment, but they require you to outsource your risk management directly to the government. The final news category is the management shakeup. This strategy is tailored specifically for contrarian investors looking to extract value from panic. The input strategy is simple. You buy the 5 to 10% market dip that follows sudden C-suite resignations. We saw exactly this sell-off recently with companies like Godrej Consumer and Colgate. As this table shows, you acquire blue-chip market share at a temporary discount. But you must navigate a significant trade-off, the value trap. If the resignation points to deeper systemic issues, buying the dip means you are just catching a falling knife. To understand this, look at DMart's current struggles. Their issues extend beyond a single bad quarter. They face aggressive, well-funded competitors eating into their core business. We are watching a rapid shift away from traditional offline retail, moving directly toward quick commerce giants. Consumer habits are changing faster than the stores can adapt. When an established company loses ground to a faster, more modern business model, sudden leadership changes usually reflect internal panic rather than a planned transition. In cases of lost sector dominance, a 10% price drop typically marks a permanent valuation downgrade rather than a temporary discount. Successfully trading management shakeups requires you to accurately distinguish between a temporary PR crisis and a loss of fundamental market power. Now we build the final blueprint. We map all these news types, sectors, and trade-offs to your specific investor profile. We define our matrix with 2 parameters: time commitment on the horizontal axis and catalyst type on the vertical axis. If you are a time-poor or beginner investor, your blueprint places you strictly in the top left quadrant. Focus entirely on structural plays like AMCs and heavy engineering. Your strict rule is discipline. Actively ignore weekend geopolitical rumors and scroll past tempting 50% upside targets on mid-cap stocks. They do not fit your timeline. If you are an active optimizer with time to burn, your blueprint is on the right side of the board. You have the bandwidth to trade government policy shifts and track defense sector order books. But your mandate is different. Your edge isn't reacting to the initial order announcement on television. Your edge is tracking the actual quarterly execution of those specific contracts. This brings us back to those 10 stock picks published by top-tier brokerages. Never treat these price targets as guarantees. They are simply hypothesis documents written by analysts. Your job is to read their thesis, cross-reference it with the 3 trade-offs we covered today, and decide if your portfolio can afford the specific tax that strategy demands. In a market flooded with information, true financial edge comes from knowing exactly which headlines to ignore based on your personal matrix.